Thank you guys for coming. We really appreciate the attendance and the support. Obviously, this is a topic that is very, very intriguing right now. We'll get into the background on Caliber. I don't want to spend too much time on my own background, but again, thank you for coming. We do want this to be interactive. We do have a dedicated Q&A at the end, so if there are specific questions, maybe not pertaining to this, let's hold those. But if you do have something on the content, please, I want to be engaged with everybody and make sure that everybody's getting what they intend. Again, we already kind of introduced ourselves, so I don't think we don't need to run through this. So to give you guys background, who is Caliber? Caliber is, in industry parlance, we are a real estate private equity group based and headquartered in Scottsdale, Arizona. We were formed in 2008, really two young co-founders. One was a CPA by background, the other was a real estate professional, architect and design. And they met in the ashes of the financial recession, fixing and flipping single family homes, just personally with their own money. And after doing that dozens of times together, they had friends and family that came out of the woodwork and said, we'd like to support you. Why are you funding this yourself? Let's work together. And that's when Caliber was born. So fast forward just about 10 years, we're at about 400 million in assets under management currently. We've raised north of a couple $100 million in direct equity. We've really built our business model on working with individual accredited investors that are allowed to participate in private placements and limited partnership type investments. So some of our principles that are important, we really try to put a heavy focus on the end client and the customer. And that's not being from Wall Street and a background with much of you in advisory business. That world has evolved now. I think the fiduciary standards have changed, and I think it's been a very positive thing for the end client. I was really intrigued by Caliber because that's when they started the business. It's where our roots were founded, and in fact, in our name, the Wealth Development Company. And so that is really intended for our end clients. Some numbers, we estimate this. This is just something our CEO and co-founder Chris Loeffler came up with, that we track all of our clients and as far as their investments into our products and working with us. But we also know that we don't maintain, like an advisor does, their total portfolio, right? Nor should we. We're a real estate allocation of a portfolio. But we do estimate that amongst our 500 plus accredited investors, the total purchasing power of Caliber is about $2.5 billion. And so that kind of takes us to what have we been doing in the last 8, 9 years that got us to opportunity zones, and why are we here? I'm not big for, recognizing awards, but it was something that was important to me a couple years ago when I was doing my due diligence on Caliber, was to understand who they were and why they were being recognized in the community. So there were some ethics awards, and there was one of our co-founders is a woman, and she's been awarded many different things within Scottsdale for being Women in Leadership Awards. But let's talk a little bit more about our geographic focus, and we'll get into what we do, but I do really want to keep this educational around ozones. I'm just trying to give you a sense for who we are so you understand who's speaking to you and where we're coming from. Caliber, as I mentioned, is based in Arizona. We're in about 6 states. We call it the Greater Southwest. We're not going to invest in Seattle or San Francisco or New York. We're really a mid-tier regional private equity real estate sponsor. And what that allows us to do is participate in transactions that are not at the very top end where the institutions are competing for that dollar, and at the very smaller end where individuals and small partnerships and groups of people are purchasing real estate. We traffic in that $15 to $50 million range, and there tends not to be as much competition above or below. It does require some expertise and some structure and knowledge, but that's really where we've come this far because of that. So back to our investment principles. The first thing is clients' profits first. That's something that we believe in. And that's something I was attracted to with the nature of our structures, which we'll get into and maybe even more after this with questions. But really focusing on the client and keeping a fund structure low from a fee perspective was extremely attractive to me, coming from my background. So not only do investors profit first, but we like to not necessarily rely just upon the market for what we do. We like to make sure that our structures are taken care of properly, and we're trying to buy assets that we feel are undervalued, whether market or non-market. That's what allows us to force appreciation based upon these principles. And income creates value. So we operate within all asset classes. That's something that's a little unique versus maybe some of the other private equity real estate firms you've spoken with. We're not just apartment guys, and we're not just hotel guys. We're vertically integrated, and we operate in multiple asset classes. And that wasn't really intentional, I would say, from the outset. It was more a function of growing and seeing opportunity and deal flow. And when we graduate into another asset class, not only would we learn, we would bring on new partners and resources. And now we're pretty much asset class agnostic when it comes to single family, multifamily, hospitality, self-storage, commercial, industrial, and even ground up development. And so again, back to our strategy, acquisition, I already kind of mentioned this, build value, I mentioned that. Financing, this is something that has been much, I would say, a primary focus of us in the last couple of years. Because as we've graduated into larger asset purchases, the need for financing that makes sense has only grown. And with the addition of people like Colson, and we've added several people to this team, but that's really a function of us growing in profile and not just taking what loans we could get on a property. Now we have the option and the opportunity to work with multiple lenders and structure our financings. This, in my opinion, I'm not talking macroeconomics, I'm talking as it relates to Caliber, I think is going to continue to be a benefit to Caliber, because as our profile as a company is growing, we're seeing better credit terms and we're seeing better lenders willing to work with us now that we have an established track record. And we've also are on track to the parent company to be public. I don't want to get into that too much today because that'll throw off our conversation, but we can certainly talk about it later. Again, mentioning asset classes, we are very diversified. This shows some of the assets that we have within each asset class. But the point I'm trying to make is we're not specific in any one area. We really a generalist and we're opportunistic. So if we see something that we think makes sense and we can model it out and understand what it looks like maybe 5-10 years down the road, we're willing to participate. And that's how a lot of these different assets came to be. So most of you probably know what a real estate private equity fund, given your background. We've done a lot of these presentations. Just to be clear, Opportunity Zones has been very, very popular since we announced our first press release and then opened our fund. And so I've been at Caliber just under 3 years. I've never seen the demand and people knocking at our door that I've seen in the last 3 months. And it's not just random investors. We're getting calls from very, very big institutions and very, very large investors. And I'm not saying that to prop us up. I'm saying it's just, I think it's going to add to our ability to scale our business and grow our business, which we're trying to do anyway. And I think that's one thing I want you all to take from here is when we looked at our asset base of what we're invested in Arizona, when the designation of the census tracts and ozones came out, we did a quick and dirty back of the envelope calculation. It was north of 50%. And I say that not because these will be qualified ozone investments, but because we were operating a strategy in these regions prior to ozones even existing. And I think that's a little unique that not a lot of people were set up with a platform and a vertically integrated business and the resources and the know-how to then, when they do raise money in an ozone, to deploy it effectively and keep everything eligible and in line with compliance and the regulators. So private equity fund, for those of you that aren't, yes, please.
So the uptick that you're seeing right now, is that because of something unique that you're doing, or is that just more generally because of the interest in Opportunity Zones today? It's a
great question, and it's a tough one to answer. I would say there's a big component that's just ozones, and we happen to be right place, right time. We'll admit, we got lucky. We got lucky that we've been executing a strategy, and the tax legislation fell in our lap. But that's also why we jumped in front of the legislation with press releases, even before we had a subscription documents, PPN, and a fund open, because we know nobody in the country would have that either. And so we thought first to market in this particular instance was very important, and we've kind of been, justified in that movement.
Paying off.
Yeah, and so anyway, the point being is, yes, there are people that are interested in specifically what we do. What I'm finding when I'm talking to prospects and clients, they're interested in ozones, and maybe they find us because of ozones, and then when they learn about our background and our other funds and some of the other things we do, they realize we're not just an ozone fund. And so there are benefits to whether the end investor or Caliber by making participation and acquisitions in ozones, but there are ancillary and tertiary benefits that will come about that other parts of the portfolio and other funds will feel. And I'll get into that later. I want to focus again on ozones. But just so you understand, again, a limited partnership fund, this is what it would look like. This would be, say, one of our funds or the ozone funds and owns these assets. The Caliber is the general partner, and then the investors over here are the limited partners, right? I'm not getting this. There we go. So I think most of you are probably familiar with this. I don't want to drill on small educational things, but this is a cash flow kind of cycle that we've shown, and we do this with a lot of our individual clients, simply because they might be new to real estate investing, they might be new to private equity, they might be new to limited partnerships, and they don't necessarily understand the flow or the velocity of a total portfolio, total acquisition process, and how that matures and how we harvest those gains. And so I just put this up here so that people understand, typically when you're investing into the dirt in construction and development projects, you're not going to be throwing out cash flow and distributions in the first 2 years, right? Because you're still going to be in the ground. But there is an inflection point, usually 4 to 6 years, depending upon which asset class, where it kind of tips. And now, rather than forcing the appreciation on the asset, you're gaining your cash flow and the asset has been optimized. And so that's kind of how we think about the long-term cycle. But this goes back to my finance background. I think the world in the last 8-9 years has been, I don't know what the right word is, but inflation is something that hasn't really been felt from an investment community and across the board. And that's changing. And I think it's going to continue to change. And I think we're in an interesting market right now. I'm not making any comments about that. I'm just saying I do think inflation is coming back, and I do think it's going to be stronger than we've seen in the last 7 or 8 years. And the reason I mention that is real estate historically has been a traditional, a great hedge for inflation. And so I still think that'll be the case, and regardless of what macroeconomic environment we're in. But that's one of the reasons that we feel not just private equity, but real estate in particular is an offset to any portfolio that holds cash or stocks, bonds, et cetera. So just a quick rundown of what we actually do have outside of the Ozone. We have some lending fixed income products for clients that aren't looking for, appreciation. They're looking more for just fixed income like returns. This is our residential fund, which is essentially, think of us as a landlord. We opened this fund because of our clients said, hey, I bought 6 houses in the valley to retire and I would have cash flow that would pay me a salary. I didn't realize that I took on another full-time job. Taxes, tenants, toilets, plumbing, and now all of a sudden they went from a retirement opportunity to having 6 homes, and they're working harder there than their primary job. They came to us and said, this is what you guys do. Is there a way that we could have this type of strategy, but Caliber does the heavy lifting? And so this was the answer to that. That fund in its first year did about 16% in both cash distribution and price appreciation. And it's been paying monthly distributions along with the tax benefits you would get in investing in real estate. This is our commercial fund, which we launched last year, which is really going to touch almost everything we do in the commercial world, which is everything but our single family. And then finally, what we're here to talk about today, which is our Opportunity Zone Fund. So I want to bring in Colson because I don't want to just rattle about Caliber. I really want to talk about opportunity zones. And I think this is a good transition slide for you to talk, what are we going to learn today and what is the focus? We'll switch with you here.
So I mean, you have to go in front of me.
Okay.
We're wired here.
Musical chairs.
Don't want to trip. But yeah, so I mean, basically the idea here is, we're not going to cover everything related to opportunity zones. There's too much to cover in just a 1-hour session. So I'm more focused on the aspect of, okay, so what is an opportunity fund? What does it take to qualify as an opportunity fund? What are the tax incentives, for investors who want to invest in these opportunity funds? And there are, a number of incentives that are very attractive to investors. So that's why there's so much attention that's being drawn. And then just going into some of the rules of, there's a lot of rules, and this is, much more tax focused than any of these other funds that Travis mentioned or any traditional real estate partnership. This is very tax focused, and we have to comply with a lot of rules. So we're just going to get into some of that. We're not going to talk so much about some of the fund specifics, although I'm happy to answer questions, and but we're going to focus more on, as much as possible, on answering questions, so that you're able to answer questions from your clients of, I have this gain and I want to invest in Opportunity Zone. How do I do it? How does it work? What are the pitfalls? What are the returns that we're going to see? So that's what we're going to get into. These are just some headlines. I mean, the one on the right there is when we launched our fund in Phoenix, it was highlighted, and then this is something that really started with the tax reform that passed a year ago, and it was kind of a provision that wasn't well known in the beginning. It took a month or two, but then we found out about it in January or February. The law was passed in December, and as I've been following it since that time, before it was really well known, I've just noticed kind of a momentum building and interest, and now there's all these articles in Wall Street Journal, mainstream places, basically any real estate continuing education course that I've been involved in. This is a topic because this is new, and there's just a lot of interest and attention surrounding it. So that's just to highlight that. So, opportunity zone investing, what is it? What are opportunity zones? I mean, that's a good place to start. Opportunity zones are designated areas that the tax law outlined some requirements, basically a certain level of median income. I think 80% of the median income in census tracts, and governors for each state and Washington, D.C. and the U.S. territories were able to identify a certain percentage of these census tracts. So there's, a certain number eligible, and then a small fraction of those, or a fraction of those, probably less than 25%, I think, were actually selected. And so, in different areas in each state across the country, and there's lots of online resources, so you can look on a map and, type in an address and see, is this in an opportunity zone? See what areas are in opportunity zones. I mean, there's lots of different services that provide that, and we're happy to provide those links afterwards if you're interested. But that's kind of idea. All right, so that's where the focus is. The investments in these opportunity funds have to be in these qualified opportunity zones.
Was the legislation drafted such that it was static, or is it fluid over time, meaning that new opportunity zones can be later identified?
It is static. So basically, the opportunity zones were designated. They expire. The designation expires, I think, in 2028. However, basically the investors have to invest in the opportunity zone by mid 2027 is the latest date where an investor would be eligible to receive any of the opportunity zone benefits.
I'm going to repeat the question, Colson. So
Oh,
the question was, are opportunity zones static in nature? And I would say, as far as the numbers, yes, because it's already been designated. They were 4,000 population census tracts. The governor was able to elect 25%, and then it got pushed down to the local level, to the state and local level. And at the local level in Arizona, we were very active, even in that, if you guys are familiar with Arizona, areas like Tempe, which is where ASU is based and has all kinds of new development, was a designated ozone. And I think that was really just because the politicians and the government within our area was very in front of this. So they were aware of these census tracts and what they could, try to make eligible, versus I've seen other states that kind of missed the window. And so that's a big deal. The other thing I would say, just as an anecdotal background, for those of you that don't know how this started and got in here, what I would say is the guidance and the IRS component to it, I don't think is static. I think we're continuing to see amendments, and I think we'll continue to feel that. That's my personal opinion. That's not from Caliber. But ozones came about because of Sean Parker. Sean Parker was a founder of Napster and a co-founder of Facebook, for those of you that don't know. And he kind of came in and said, our country needs real infrastructure support, and it ain't going to happen at the government level, because we've seen no movement on that in decades plus. So he went around and got bipartisan support, kind of gumshoeing several different tax incentive laws that were in all kinds of different areas, and duct taped them together and got it passed through with bipartisan support in 2017. The reason that's important, and that's why I think we're still seeing edits, our lead attorney, Mark Schultz at Snell and Wilmer, who's become a subject matter expert on ozones and speaking nationwide, says if you read the actual original tax legislation, it's in different fonts, there's typos, it's preposterous. But that shows how important it was and how much support it had, that people didn't want to go back to the attorneys and drawing board and wait for everything to be clean. They wanted it passed, and so here we are.
Yeah. So yeah, there is more coming. We'll talk a little bit about the regulations. There was a tranche of regulations that were released back in October that clarified a lot of things, in particular for investors looking to invest in opportunity zones. We're waiting on a second tranche of regulations from the Department of Treasury that will be forthcoming either this month or early next year, that will clarify several questions. Hopefully, we're hoping that it will clarify a lot more questions about the funds themselves, rules surrounding how they pass certain tests that we'll get into a little bit, and so, but it is ever evolving, and it's likely that there may be additional legislation, because there's only so much that the regulations can provide us, and certain things that will be required to be passed by Congress and signed by the president in order to make changes to the program. But we'll talk about the information we know and where things stand at currently. And then this kind of goes through a lot of what I was talking about in terms of the different numbers. There's 8,700 different census tracts throughout the country that were identified. That's just geographical areas, and some of them were, as Travis mentioned, adjoining to these low-income areas. So if it was adjacent to the area, then the government had a certain number that they could select, and that's where some of these more attractive up and coming areas were also included. So this gives you an idea of the different map. So some of them are large geographically in nature. This is kind of the area in the Southwest where we're primarily focused on. More particularly in Arizona, what we're looking at, green areas being opportunity zones. And then if you look at, this is to give you an idea of the three biggest cities in Arizona where we are focused. You can see this right here is really kind of a good part of downtown Phoenix. So there's attractive opportunities there. Tucson, there's a good part in the central area of Tucson, and that's one area where we're focused on. And then Mesa, a suburb of Phoenix, and again, we have that area as well. And
that's Main Street, just so you guys know. I know you're probably not familiar with Mesa.
But
Mesa is one of the oldest incorporated cities in Arizona. It's one of the last to be redeveloped. If you guys are familiar, there's cities like Gilbert and Chandler that you wouldn't recognize them if you went there 10 years ago and came back today. Walkable downtowns, light rail, new restaurants, new houses, schools, hotels. We think, or we don't think, we have good reason to believe Mesa is next. And we bought 8 retail buildings. Again, we are not retail operators. We have not traditionally been. We wanted an anchor in the ground in Mesa because ASU announced they're bringing a new campus to Mesa, which is going to be their gamification, tech, and AI campus. So I believe that's going to grow dramatically. There are all kinds of new tenants that are coming into a town because the light rail has expanded. The light rail is essentially public transit in Arizona, which can take you from Mesa all the way to North Phoenix. And in the Phoenix area, one area point above the 202 right there, under Bronze Boot. For those of you that don't know, that's Old Town Scottsdale. And Old Town Scottsdale is far from a low-income area or an under-resourced area. And this goes back to my point about the leadership in Arizona, I think, was very active. So they saw some way to create some benefits. I think, and again, I just think, the Tempe reason, college kids don't make money. So when you get a 4,000 census tract of people, it's easier for a college kid not to report a W-2 income than if you went to North Scottsdale, where a lot of wealthy people in Arizona live. And so it's things like that I think they were on top of that is going to benefit our state, but there's plenty of other states that were very active, and we'll get into more about the discussion of how they're designed.
Yeah. Okay. So that gives you an idea, and and I'm not as familiar with the Seattle or Washington area opportunity zones, but it's likely that some of you may know, and you can look up later where those are. Okay, so let's talk a little bit about qualified opportunity funds. So a qualified opportunity fund needs to be 90% invested in qualified opportunity zone assets. And what does that mean exactly? Well, it's basically tangible. It's either investment in tangible assets within the opportunity zone that are either newly, so they have to be acquired in 2018 or later, and they're either new assets or assets that are acquired for substantial improvement. We'll talk a little bit about what substantial improvement is, but that's the idea. You can either invest directly in those assets, or there's an option to invest in either the stock or partnership interests of businesses that are that meet certain tests and qualify as opportunity zone businesses.
Just a little anecdotal tidbit there too. Mm-hmm. So we've been on the speaking trail with all this ozone interest. And I spoke with the city of Mesa, Scottsdale, Peoria, and Chandler. And that was one component that they really like to hear. They're not investors. They want to understand how it's going to benefit their areas. And they said, wait a minute, you can invest into the equity of a company and it still qualifies? And we said, absolutely. And they said, so how would you guys look if there's a company you're trying to recruit to your area and there's an opportunity zone? And somebody like Caliber comes in and says, hey, we'd like to build your office and we'd also like to participate in some of the equity of your company. Those would all fall within being qualified opportunity zone investments. And their ears perked when they heard that, because they thought, wow, we can recruit people to come here and there's some benefit to actually doing so.
Yeah, and so this, I'm skipping ahead a little bit, but just to highlight what Travis just said, there's really 4 different types of businesses, per se, that you could invest in an opportunity zone. And really there are 4 different ways you can invest in an opportunity zone business. First is investing in real estate. So a real estate investment where you either are doing ground up development or a significant substantial improvement. Basically, you buy a building for $1 million, the land's worth $400,000, the building's worth $600,000. You have to put at least $600,000 into the building in order for it to qualify. So that's the type of real estate investment we're looking at. We're not looking at buying, fully leased up apartments and just owning them, happen to be located in the opportunity zone. The incentive is to develop, improve, and kind of revitalize these areas. You can open up a new business located within the opportunity zone. So startup companies looking to start, if they are trying to attract investor support, that's a big selling point, either from these funds or other investors who want to set up funds and for capital gains. That's another one. You can acquire an existing business, but you have to relocate it and expand it to meet these, and it's easier if it's a capital intensive business that requires a lot of purchase of fixed assets and things of that nature, tangible property. Lastly, you can also get an expansion of a business already within the opportunity zone, as long as you're expanding either the equipment or the real estate, et cetera, that the business needs to grow. So it requires that, but that's kind of the different types of opportunity zone businesses that these qualified funds will invest in.
Colson, I have a question there. Right? It's on the third bullet, and this might be for some of the people here in Seattle. Say it's a software business. Can expansion include employee headcount, meaning that rather than fixed assets, but you're paying salaries of new employees? Would that still qualify as expansion?
I don't think so. I think it requires. It could come into play, but it's really looking at tangible assets. So either personal property, which would be, the computers and that type of stuff for those employees, that could qualify. And you're paying employees, that's fine. That's an expense. It's not an asset. But as long as you meet certain tests, and I don't think we're going to get into that as much. But it's more either a new building, something like that. Yeah. Yeah. The question. Yep. The question is, can you buy operating businesses within the opportunity zone? Yes, you can, as long as you have the intention of expanding that business. I think 50% of the revenue from the business has to come from within the opportunity zone, and approximately 70% of the tangible property. So, and I would say, either personal assets or real property has to be within the opportunity zone and meet certain qualifications. But yes, you can do it, and that's kind of like a high level what rules you need to meet. So 70% has to be qualified property, which means you have to acquire it in 2018 or later, either new equipment, new computers, new whatever, or build new real estate or buy real estate and then redevelop it in that area. That's kind of the gist of it. Yeah. Go ahead right here.
So, for a service type business that doesn't have much tangible assets to begin with, it's really not that much of a challenge for them to go and buy, 70% of new computers and new copiers and whatnot.
Yeah, I agreed. So you just have to look at the numbers, look at the balance sheet of these businesses that exist, look what they would need to do to expand. So you could definitely make it work. Yeah, it can. It just depends on the current balance sheet of the existing business. The trick is the business has to qualify on, an existing business has to qualify on the first day that the qualified opportunity fund invests in that business. So it has to have either acquire those assets on that first day, or there's an exception for cash that would be considered working capital, and you'd have to have a written plan, and you could invest in those businesses in that sense as well, as long as you have a written plan of how to expand that. Jonathan?
Thank you. Is there a basis, a sunset on the basis of improvements? For instance, we use that $1 million 6-4 ratio, and that $600K to qualify. Is there a sunset on when those improvements need to be in service, if you will?
There is. So there's about a 31-month window. You have the regulations and the tax law give you 30 months to improve it, and I think 1 month to acquire the property. So as long as you do have a written plan to improve the property within that 31-month window, and you substantially follow that written plan. I mean, obviously you can play around with that, but the law requires you to substantially follow it. Then yes, you could do that.
That's before closing or after closing? You have this plan. This plan that needs to be put together.
But basically, yeah, you'd have to have the plan in place, and then as soon as you invest that money into the Opportunity Zone business, you'd have basically 31 months to build that building or acquire the computers or what have you that you need for the business. Did you have a question here too?
I did, yeah. So talk to me a little bit in terms of, you said that 50% of the revenues have to come from the Opportunity Zone. How would that work, let's say, for a tech company or a software company?
That's a good
That's
question.
a really good question. The question was, if 50% of the revenue has to come from an Opportunity Zone based company, how does that happen within a service-based business?
And that's a good question. I think that that's one of the main things that we're waiting for additional regulations on. I don't think there's a lot of clarity on. I think it's like a wording is substantially all of the business has to be within the Opportunity Zone. So that's one thing, the 50%. But I'm not sure exactly what the measurement requirements are. How does that work for a software company? Will that qualify? Does it eliminate service, internet service-based businesses? It may. I'm not particularly familiar with how that may work.
Yeah, it's a really good question.
I had a question about buying property.
Uh-huh.
So for to have that plan to develop it, what qualifies as a plan? Permits or
Yeah.
what?
Yeah. So the question is, what are the requirements for this written plan that we've been talking about? And really, what it comes down to, the regulations aren't too specific, but basically it says that you have to have a written plan with a schedule of kind of when you're going to deploy it and specifying what you're going to spend the money on. For example, you're building a hotel, and that's one that I've been dealing with, directly at Caliber. We have a plan to build a ground up new hotel in Tucson, Arizona. And so we had to kind of write up a plan, and it wasn't long, but it kind of specified, we plan on, we're going to have X number, say $10 million by December 31st, 2018, because that's when the first testing date is that you need to qualify. Yeah, it's the end of this month. We have to have, anything deployed, it needs to be, we have this X amount of money. We're going to, spend, $8 million on the building, $2 million on, personal property. We're going to spend, a certain amount on ancillary expenses related to the development that would qualify. And then you just have that written plan. You have it on record. You don't have to file that with the tax return or anything like that, but it's just kind of a record that you have. If, you're ever audited or the IRS is ever questioning the qualifications of the investment in that Opportunity Zone business, then you have that to show that it was qualified, that the cash you had on hand was qualified because it was following a written plan. So,
You have to have that all figured out before you close on the property, or is it something?
so the question is, do you have to have it the written plan before you close? And the answer to that is no. You could have a part of the acquisition of the property as part of the written plan. I think the example in the regulation has a month, a window between the written plan and the actual acquisition of the property. So, I mean, that's all we have to rely on right now. So if you want to be safe, then I would do it within a month. You could probably do it longer, but then then there's questions as to whether you're following the rules. But definitely within a month, you should be good.
How have they released these sort of regulations? Like, if you change your plan or update it for whatever reason?
No, I mean, all it really says is that you need to, something along the lines of substantially follow the plan. So that is a question. Like, what happens if, the deal blows up and you have all this cash invested in this business and you don't need to deploy it? I don't know the answer to that. And it's not clear yet in the regulations.
Is the IRS the only oversight on these plans? It stops with them? You don't have to file with anybody local, or it's all to the IRS?
Correct. It's all. The question is it administered by the IRS or other regulatory bodies in addition? And really, it's the IRS. And then, in addition to that, the state at the state level. Some states are complying and conforming with the law. Others are not or have not yet made a decision. So, I mean, you would have to take that into account. But I think the states are basically, just writing the legislation that they conform with the federal law as written with regard to tax reform or with regard to opportunity zones.
And it's a self-election, right? So they're not going to know until you file your tax and say, hey, by the way, the $2 million you think I owe you is now in an O zone.
Yeah, right. So yeah, and we'll get into that. I'm going to move on here, talk a little bit about so that's an idea of, all right, what the funds are, what funds need to invest in. Let's talk a little bit about the investor side of it, the capital gains. This may be what you're more familiar with, but we'll highlight some of that. I guess before I do that, let me just talk about this really quick. A good comparison, or a lot of the comparisons that I've heard are, this is in some ways like a 1031 exchange, which a lot of us are familiar with, especially if you're in the real estate space. It's a tax deferral. Most of the 1031 exchanges went away except for real estate 1031 exchanges with tax reform. And so what's similar, what's different? So 1031 exchanges, also known as a like-kind exchange. So you'd have to, if you have real property, you have to exchange it for real property. Opportunity zone investment, you can have any capital gain from the sale of stock or other investments, the sale of a building, the sale of a business. As long as it's capital gain, you can reinvest that into the opportunity zone. And it doesn't have to be in any like-kind type investment. In addition, there's no requirement. You have a 45-day identification period with a like-kind exchange and 180 days to reinvest. You have that 180 days still, but there's no 45-day requirement.
It's 180 days to invest in opportunities on the property, not necessarily for the fund to close on the property. Right?
Correct. So the 180 days from the exactly. Yeah. So even that is a distinction. Good point that you have 180 days to close or to reinvest in the fund, but then the fund has certain time periods to then deploy that capital. Go ahead.
Correct. If it's a partnership, the question was it's 180 days from the incurred capital gain, or if the investment was made in a partnership, LLC, S corp, then the end of the tax filing year is when you can elect, and you have 6 months from there.
Yeah. So that's a big incentive for partnerships, and we can talk about that in a minute.
We can absolutely send it to you.
Yeah, we can set up the slide deck to everybody. I think there's lots of good content in here, and then follow up with questions to us if you have additional questions. So anyway, just to kind of go through a little bit more, like-kind exchange, you have to invest everything, all the proceeds. If you don't want to realize the gain with this, you're only investing the gain itself. So you have the initial basis that you can pocket, you could spend on something, you could invest or reinvest in similar stock. If you just sold stock, you realize the gains, you put it back into that Microsoft stock or whatever stock you might want to invest in, and you're kind of in a way harvesting gains and diversifying your portfolio, and you don't have to pay the tax on those gains.
The question I get a lot, Colson, on that point is, do I have to invest all of my deferred capital gain? The answer is no. And even it might be self-defeating, but I say it would be an interesting idea to look at multiple ozone investments and ladder and diversify your cap gain deferment, right? And we'll get into some of the risks of these investments so that we can discuss that.
Yeah, but there's not a lot of limitations. I mean, I'm not going to go through every single thing on the slide, but the idea is, there's a certain time period. This talks about, the like-kind exchange recognition period is kind of indefinite until you sell a property that you've done the exchange into. This, we have a recognition date of December 31st, 2026. And then there's also a step-up basis. If you have the investment in the opportunity fund for at least 5 years before that 2026 date, then you get a 10% step-up in basis. You're only realizing 90% of your gain. You're only having to pay tax on that. If you have it 7 years, then you get a 15% discount on the amount of gain that you're going to have to pay on. So what's the catch? And all right, so funds have to raise money quickly. As I mentioned, we have those 7 years before December 31st, 2026. So that's the end of next year. In order for investors to fully participate in all of the available tax benefits. And I'll get into some of those on following slides. So if you have questions on that, we can talk about that in a second. Again, we talked about this already. 90% of the fund's assets have to be in qualified opportunity zone investments, so either property or investments in opportunity zone businesses. And then you have to substantially improve it. That's what we're talking about, 100% improvement on a building within 30 months. Question back here? So it might not be 2.5 years. It might just be 2 years. I think it's starting from the beginning of this year, so beginning of 2018. I guess technically, if you had at this point, if you had a gain from a partnership,
that could be
January 1st, you could still, elect to invest that into an opportunity fund, and then anytime this year or next year, you'll still get that 7-year maximum 15% step up in basis.
Sorry, can you just clarify the types of capital gains that can be rolled into this type of vehicle?
Any kind of capital gain. So
Correct.
Yeah.
I was going to mention that on the last slide because I'm on the capital raising team, right? And so I'm dealing with a lot of the prospects that call in to discuss this. We haven't had discussions with stock investors like this at Caliber, at least myself, until Ozones came about. So traditionally speaking, it was people looking for alternative investments or looking for real estate. Now I've got guys in New York that trade options and made 30 million and go, hey, I got $6 million I need to defer. And he doesn't even care what we do. He just wants to defer. Yeah, it's exciting from a capital raising standpoint. It's fantastic, but that's just I'm not blowing smoke. That's a fact. We're getting calls all the time. Hey, can you take $3 million? Yeah, I just got to get this going in the next 15 days. Yep.
Yeah. So to clarify from a more technical tax standpoint, what types of gains? Long-term capital gains, short-term capital gains, 1231 gains, basically anything that would be considered a capital gain. So the one where you might not, if it's an ordinary gain, then it's not going to qualify. So things associated with depreciation, recapture, those type of gains would not qualify. But anything that is a capital gain, whether short-term or long-term, would qualify. And there's discussion in the regulations about Section 1256, positions and lots of technical jargon around very specific types of things that are treated as capital gains, and anything along those lines qualifies as a capital gain that you can realize and then invest the gain portion into an opportunity zone fund and defer that till 2026.
And Colson, correct me if I'm wrong. I was doing a presentation with Mark Schultz,
Mm-hmm.
and he said in the original bill, it didn't even say capital gain. It just said gain.
Yeah. So we
there
didn't
was
even
a
know
big
that.
throw of the hand saying, wait a minute, so any gain? Because that's
Yep.
not just capital gains. That's ordinary. I mean, we could
Yeah.
run through the list. And so I think they narrowed the scope a little
Yeah.
bit, but it's still very wide as it relates.
The regulations clarified that the statute itself doesn't specify. It just has, I think, capital gains in the titles, but in the wording itself, it just says gains. But it has to be what would be considered a capital gain.
From what I'm starting to see in here a lot, it seems like the toughest part of finding properties that work for this is the 100% threshold of purchase price in rehab or development. I mean, development and rehab. And then in October, I think you mentioned this earlier, part of October's clarifications was that they said for the building basis only, no longer include the land in that. So then in theory, if you bought something that was a tear down and most of the value was in the land, that percentage threshold would be a lot lower.
Yes, and so yes, but I will caveat that. So what you're referring to came out, and it wasn't in part of the regulations, but there's a rev proc that came out that same day that gave an example, and I think the example was you acquire a building and basically 60% of the value is in the building, 40% is in the land. That's raised a lot of questions in the real estate community that's interested in that. Is like, well, if it's all land, what if I buy land and improve it 5%? Do some basic improvements, build a shed on. Who knows? And really, the purpose is to hold the land. That's something that doesn't really make sense from a regulatory standpoint. Like, that's not what they're trying to incentivize.
It's not the intent of the law.
It's not the intent of the law. So I would expect that might be one of the things that could be further clarified. And Mark Schultz, our attorney that we work with, he's written articles about that, and that's one of the questions that he expects to get some answers on.
Starting to want to get into capitalization about real estate this morning, but I know when the investment reviewer and IRS audit, the first place the IRS goes to is as the county assessor, and we all know in this room that they're not entirely all that accurate.
Sure.
We look at real estate different at a federal level than certainly on a county level. We won't get into that either. But that being said, in those regs or in the guidance, has there been any guidance at all about how to go about capitalization between building and land split? Because at the end of the day, as long as it's supportable, and it's in my world, as long as it's been supported documentation of what the building and land split is, you're not married to the county assessors.
Yeah.
And that's the most common area.
Yeah,
So
yeah. There's not really a lot of specifics. I think, I mean, the industry standard, I think, is to get appraisals, kind of typical with other.
You tend to mirror the county record office.
So I mean, so there's
I'm just curious.
appraisals. I don't have
There's a lot
a.
of wiggle room there.
Yeah, I don't have a good answer to that. I mean, I know that the tests are done based on the applicable financial statement. So if it's a public entity, then it would be, whatever those financial statements are. If there aren't financial statements, then I think it defaults kind of to the tax basis. But other than, as far as measuring the land value, there's not guidance. I think that's, and I don't know that there's guidance on other areas of estate law or things like that where you look at valuation. But that's I don't know that we will necessarily see that come forth. So that's a risk, definitely. Go through the rest of these on this slide. So there's, these investments aren't necessarily as flexible. You have to kind of do the deals that work in the area. You can't build a hotel in an industrial area or things like that. So that's something you have to be a little bit flexible, and it limits the type of businesses that are really going to succeed in opportunity zones. And then there's risk. There's this 90% test is tested twice a year. So basically within the first 6 months of investing, or the end of the year. So in a calendar year business, it'd be December 31st. If the fund started as ours did in July, it was organized. So we have our first testing date coming up at the end of this month. We have capital that we've raised. We have to figure out how to deploy that and make sure that we're passing the test. Otherwise, I think it's a 5% per month penalty or something like that that is assessed, and that's on form, I think it's 8996, where that's the form where you're making the self-certifying as an opportunity fund, and that's where the penalty would be calculated if you're interested in seeing how that works.
I want to highlight this bullet point, though, especially for this audience, Colson, because I do work with a lot of our advisor clients and prospects, and this is one that Marty and I were actually talking about before this event started. I think this is the component, if you're in a fiduciary capacity, that you need to pay the most attention to, because you're going to be putting clients into a tax deferment vehicle. And if the GP or the fund, or for whatever reason, that eligibility is not maintained, it's not the RIA or the advisor, it's not the GP, it's not the fund managers that get hit, it's the end client. Now, personally, I do think new regulations will clarify that, because as most of us know, regulators like to protect the smaller individual than the bigger corporations. But as it reads right now, that's a huge risk, especially in a fiduciary capacity. So it's something that I'm just making sure that when I work with advisors, understand the legal team, understand the principles, and understand their strategy in detail, because it's not just going to be raising money. I think anybody that throws up an ozone fund is going to, I don't want to say easy because that's never the case, but it won't be as difficult as it was in the past to raise dollars. I do think the big problem will be raising the capital, keeping it deployed properly, maintaining these rules. There's hundreds of them. And so that's one thing with Caliber. I feel we have a little bit of an advantage, because one, we've been operating a strategy that worked like this before ozones were around, and two, the subject matter expert, Mark and Snell and Wilmer, they wrote our documents. And so we're actually expecting, I think today.
Yeah, I saw a draft of a revised
over the weekend.
PPM,
So we're trying to stay in front of this. We wanted to, again, as I mentioned, get out there with the demand and the interest of this new tax bill, but we also wanted to maintain some flexibility so that we can raise a bunch of money and deploy it, and now all of a sudden the rules changed. And so that's where we've been an advantage to have Snell and Wilmer close by our side, guiding us along this process. So.
So the question, so you said your fund started in July, and
Yeah.
so you raised capital, and then so I'm trying to understand.
Yeah,
the
so-
difference between the 1 month and the 30 month.
yeah. So
We weren't open. in
let
July.
me clarify. Yeah,
the fund was being formed. I think we opened
the
like 4 weeks ago.
entities, the legal entities formed were formed in July, and I think that's where you have the 6-month testing starting from. So because it happened after the end of the year, that's when they formed. We, I think, raised our first money in either October or November, and so we've been raising money. And so basically we have December 31st is when we have to deploy that. We can't just have that cash sitting around, or else we're not going to meet that 90% test. So the easiest way is to, either you have to deploy it directly, or you can invest in these opportunity zone businesses. So our plan is we have partnerships set up, and you have to invest in the partnership interest. We're going to be the fund is going to be a 99% partner in these opportunity zone businesses. For example, the hotel I mentioned, ground up development. And so we're going to, put, a certain number of dollars into that fund and into other businesses that are, projects that we have lined up, and we'll have the written plan in place, and then the money will be there. And then we'll continue to raise capital for the next 6 months. And then again, on June 30th, we'll have to do the same thing. So that 30-month time frame really doesn't start until the money is deployed into those underlying businesses. And, we have a plan to do it in 2 years, but we have 2.5+ years. It's 30 months from when the cash is basically contributed to the partnership.
And so then they have the 30 months or
30,
months.
yes, it's 31 months, I guess, technically.
Okay, but what if they haven't, or have they all been like acquired a property or something, or they then like you have a plan, but if it hasn't closed through due diligence or whatever.
Yeah. So yeah, there's flexibility, and the question is, what state does the plan have to be in? I mean, it could be either, you have like a letter of intent to purchase a property, and ideally it would be to close within a month of putting it in there, and then you have a plan in place to construct or deploy the cash in a qualified manner within 30 months, and that's kind of how it works. I don't know if that answers your question.
Question?
Yeah, so the investment's up front, it's not capital calls like
Right. It's a little different. The question is, doesn't this involve capital calls? And it's really different because the investors have only 180 days to realize their gain and then reinvest it into an opportunity fund. So it's very different from what many partnerships do with capital calls periodically as cash is needed. So we're going to have a lot of upfront cash, and
they're really trusting as an investor that you are going to need.
Correct.
yeah, that is one of the requirements. It does require maybe more trust than a typical real estate investment.
Well, and I want to jump in here too, just to give you real world numbers. So I think we opened our fund accepting subscriptions 4 weeks ago, 5 weeks ago. We've accepted 12 million, and we've got another 20 to 25 million in LOIs, which touches to your point. Traditionally speaking, Caliber did not take commitments and then go draw down on those commitments. The way we've effectuated our strategy was identify an asset, work the financing, build an acquisition summary and a model, and then we take that to our limited partners and prospects. And they have the ability to say yes or no into that particular project, or you know what, I'd rather invest in a fund that also might participate in that project. It's completely different now because we've never done capital calls. Like I just mentioned, there's 20 to 25 million ready to go, but we are trying to be cognizant of the limited partners' timelines and clocks that they have to hit. So a component of that 20 to 25 is in partnership incurred cap gains. So we know we have till next June before we'd have to call that capital, and they're comfortable with it to watch us work as well as give us that commitment. So it's like, hey, now we have to deploy this. We've got a big building. We're going to pass it.
So the investor in Ray is their return, since they don't know what your return might be, that return is really deferring.
Correct.
Yeah, the tax incentives are the biggest selling point for sure, and we have some slides that will cover those since we haven't talked a lot of specifics on the investors.
I always say, what's the alternative? You can pay Uncle Sam or you can defer it, right? Now, that's if it's a stock cap gain. I realize if it's real estate, you have other options, but that's something that we're just trying to make sure we maintain because compliance and eligibility is something we're heavily focused on as we're growing this business.
Question in the back? Yes. Yeah. So December 31st, 2026 is when the deferral end date is. And basically, we're talking April 15th, 2027, when the investors would likely have the tax due, depending on their situation. the question is, will that December 31st, 2026 date be extended? And to answer that, I don't know. I mean, in the beginning, when we were first looking at this, we thought that, you know, there was kind of a weird matchup because there's this 2026 date, which is 8 years of deferral, but then there's a 10-year requirement to get the full tax benefit. So it was almost like an error in the law. I don't expect that to be corrected from anything I've heard at this point. I mean, but there is, you know, possibility, and this has bipartisan support. You know, Democrats and Republicans both support this, so there's a possibility that, if anything, in a separate bill, perhaps that it could be expanded or extended, and perhaps depending on the initial success of the program. But that's all speculation. We don't really know.
Doesn't seem like it really a long enough. It seems like they got you in a pretty tight box.
Agreed.
Capital raise, identification, deployment,
Yeah.
building, the whole J curve.
Mhm.
Kind of 2026 will be here before you know it.
Exactly. And that's actually something we're being conscious of as well. We're looking into different strategies or facilities that, in the event the money is deployed in the ground, and while it might be spitting off some cash, wouldn't be enough to cover somebody's tax liability come that date. We're looking at what type of options do we have to create a liquidity event for the LPs that need to pay their taxes, but not blow up everything in the fund if you know it's still growing or working or being deployed. Correct. That's what I mean. Saying you're half built through a hotel, what do? Sell it to another developer so you get these guys can pay their taxes? That doesn't make sense. So we're looking, and again, we haven't finalized anything, but we want to stay on top of this, and that's where we're again leaning with Snell to say, hey, this is going to happen, and that window is going to be a pain for a lot of the funds that raise money early, and just in general, how can we fix that, or what can we do? And so,
Yeah, so potential
But that's a big
refinances and
question.
things like that are some options
Correct.
of what we can do. You know, not have it as highly leveraged in the beginning, and then refinance at that point to perhaps make distributions.
I had read somewhere that, and I know somewhere is very big. So take this with a grain of salt. But I read somewhere that you know, it's a really tight window to establish and roll the capital gains in. However, once they're in the period for the not the 10 or 15% capital gain from the investment itself doesn't expire till like 2048 or sometime way.
Yeah.
out of the business.
So we have a timeline here. I'll get to that in a second. If no,
No,
that
it's
you're
okay.
fine.
It's good.
I think, but there's a slide that it has kind of a timeline that will kind of answer some of these questions, because it is a little confusing with all these dates and time periods, and I don't want to confuse you guys. So, 180 days is the time window. These, just to give you an idea, I mean, basically, where is all the information from this presentation coming from? So, code section 1400Z-1 and Z-2. Basically, Z-2 is where most of what we're talking about came from. Z-1, I think, identifies how to select the opportunity zones, the proposed regulations associated with those code sections, this revenue ruling, and then Form 8996 and the instruction to that. There's a draft of that out from the IRS, and that has some additional clarification that wasn't in the regs at all. All right, so this will kind of take us step by step on what are the steps in the process for an investor and the fund. So first step is the fund is set up and formed, and we've talked about that. Then an investor with a capital gain within 180 days can reinvest that take that gain amount and invest that into the opportunity fund. And the benefits are a deferral of the capital gain through December 31st, 2026, the 10% step up in basis if you have it at least 5 years before into 2026, 15%, so additional 5% if you have it for 7 years, and then the other benefit, which I don't think we've talked about as much, but is the biggest benefit, is that if you have the investment for 10 years, then you get to basically the gain from the appreciation from the time you invested till you exit the investment. That appreciation is excluded from tax. You basically get a full step up in basis in that piece of it, and that's an exclusion. That's, I think, the biggest
component.
biggest
Everybody
component.
talks about the basis and the deferment. The reason people are coming out of the woodwork is that third component, and we call it Roth-like because it's easy to understand. However, I think it will make Roths look small over time.
It has to be the gain. So if you invest any money that's not coming from a gain, then you do not get any of these tax benefits. To clarify and emphasize that point, it has to be the gain that is invested in the capital gain that's invested in this. So anything above and beyond that won't get all the tax benefits. Inevitably, that's going to happen because investors now they're going to estimate what their gain is, and sell of a business or something like that. That's a complicated calculation that takes months to figure out the actual gain. So some of that maybe investors will end up having investments in funds, small slivers that may not have any of the tax benefits, but that's just how it's going to work. Question? Yeah, so it's really the at the investor level. The question is how the gains are taxed, and it's really at the investor level that gain is deferred. So the investor's gain from the initial investment is deferred. Well, let me rephrase that. That's not what it is. It's the appreciation in that investment. So from day one through year 10, you buy it. Your investment is $1 million, and then you sell out of the partnership and you get $2 million in cash. That $1 million appreciation is not taxed at all. So that's the Roth-like.
But how does that 10-year full exclusion of that second capital gain fit inside the window of 2026?
So that goes beyond 2026. That piece of it goes beyond 2026. Really, 2026 is the and yeah. Let me skip ahead because this will answer some questions. All right, so let me just walk through the timeline. This will answer a lot of our questions that we're getting. So the law was enacted at the end of last year, and then investors were able to invest starting on January 1st of this year. That's when investors could start investing. That's when the Qualified Opportunity Zone funds could technically start. Basically, all right, if starting in 2028 or 2018, you have a 5-year length of investment, then you're initially deferring the gain. But after 5 years, you get a 10% step up in basis, so that you're only going to pay tax on 90% of the gain. If you are able to go 7 years before the end of 2026, then that increases to 15%. And then all right, here's the big deadline that we're kind of talking about. That's really the last day that any investor can realize a gain and invest it into the fund. So basically, that's where, all right, so 180 days after December 31st, 2026 is, almost June 30th, June 28th, 2027. That's the last day that gain can be put into the fund. And then 2028 is just the expiration of the Opportunity Zone designation. However, the regulations clarify that doesn't impact the fund, and if you have the investments in before that, you're fine. And then it's a 10-year period from when your investment goes in. So basically, up to so anywhere from 10 years from 1/1/18 to 10 years from 12/31 or 6/28/2027. You have to hold it at least that long whenever you put your money in the fund, and then you're going to get that full exclusion of the appreciation. And then it's not on here, but the last question about 2047, basically you have until 2047. So they're giving you, basically 10 extra years, because we're looking at 2037 would be the last investors in would be able to then have exclusion, but they don't want to flood the market with all this real estate that needs to be liquidated or businesses that need to be liquidated. And so they gave an additional 10 years. So basically December 31st, 2047 is the last. You can hold your investment until that point, but you need to get out of it at that point in order to get the full exclusion. Otherwise, you're going to miss out, and then you're going to owe tax. So that it's almost a 30-year window we're talking about, but you just have to understand the timeline and the dates. Let me just go back to where we were. Let's see. So a gain is reinvested, and then the Qualified Opportunity Fund has to use that investment to invest in either Opportunity Zone property or Qualified Opportunity Zone businesses. And basically that needs to be done by the testing date, which is December 31st typically, or June 30th of each year. And then the investor can hold their interest as long as they want. If they sell their interest or liquidate their interest before December 31st, 2026, the tax is due at that time. If not, then the tax would be due at the end of 2026. And then, as mentioned, 5-year and 7-year holds. Before that time period, you get a 10% and an additional 5% step up in basis. Question here?
Yeah, given the time horizons we're talking about, how does this have an impact in terms of estate issues?
There's not a lot of information out there, but my understanding is that if an investor were to pass away while holding this investment, the tax would be due. I think it'd be income and receipt of decedent at that time. Similar to like an IRA or something like that. But my understanding is that the exclusion would carry over to the beneficiaries or the heirs. There's that's just a comment that I heard from our attorney. I haven't really seen anything in writing, so don't quote me on that. And please, if you have that situation, please seek additional guidance. But that is my kind of high level understanding of in terms of passing on to heirs, like how that would work. So the tax would be due immediately, but the exclusion would still be a benefit to the heirs that would continue as investors. Moving on, the investor's capital gain deferral ends at the end of 2026, as we saw in that timeline. And then if you hold it at least 10 years, you get a full step up of basis to fair market value when you liquidate your position and get out of the investment. Looked at this slide already, so that's the timeline. Just to, we talked about this, so I'm going to, just go through this quickly, but there's a tax deferral of up to 8 years, roughly. Potential exclusion up to 15% on that deferred tax. Complete exclusion from the additional appreciation of the investment from your initial investment to the exit of that investment. And then you don't have to pay tax until end of 2026 unless you sell or liquidate earlier than that. And this kind of we've talked about, but partial exclusion, basis step up, and the stepped up basis applies at the earlier of that date or liquidation. And again, I think this is something else we've touched on. Here's the different dates. The opportunity zone designation expires at the end of 2028. However, a taxpayer may continue to hold their investment up until the end of 2047. So we have about 29 years from now before an investor would be required to liquidate and still receive the full tax benefits.
Colson, this is kind of something that we focus on internally. I think you're going to see a lot of limited partnerships, funds, and groups pop up with Ozone Investments because this is going to be a very big program. But I would be concerned, and as you're vetting and doing your due diligence on other sponsors and other Ozone potential investments, do they have the track record or the sustainability to be around for 40 years? And that's something that we've talked about since day one. We're not building a business to open a fund, sell it, and woohoo, we're done. We're trying to build a business with generations of families because we've worked directly with the clients. We've worked already with several generations of parents and now their children, and they want us to work with their children in the future. So we're trying to establish a business that is going to be here long term, and it only suits to what's going on with Ozones versus Colson and I could start a Ozone fund tomorrow and we're on our own, but can I give you confidence that we'll be around in 40 years? Probably not.
So that's a good point. If you really want that appreciation of value, you have to be selective in what funds you're investing, not just anybody who has a fund that will get you these tax benefits, but still due diligence is still a very good idea.
I have a question about your just the tier, the way that it works. So the underlying investment partnership that you guys are in, let's say 6 years from now, that you get a really attractive offer and somebody wants to buy it, right? And so then our taxpayer that came in the fund, can you reinvest and redeploy those funds?
That's a really good question. So that's a question that a lot of people are thinking about that because the question relates to reinvesting funds or reinvesting money received from the sale of assets owned by the fund. And the short answer is we don't know. That's one thing that we're hoping that we get additional clarification on. I've heard that may require legislative.
So makes
changes.
sense. It's like, are you stuck in an area that
Yeah.
Flint, Michigan doesn't
Well,
prosper?
Well, I think you could, yeah. So the issue with that is, all right, you could definitely sell, but then does the gain pass through to the partners
Right.
of the fund,
Trigger some type of event.
where the partners are, their intention is to, have no.
commitment for a 10-year hold.
Right.
That's the best case scenario, and then we're hoping maybe that there will be some exceptions to that, but that might require not a regulatory clarification, but a legislative, additional law. It's my understanding that the Treasury doesn't feel like they have the band or like the leeway in the way the law is written to do that themselves. So it might require additional legislative changes for that to happen. So that is an issue that
It gets talked about too internally because
Yeah.
the question we have, hey, that would be fantastic right before 2026, and people are going to have liability they need to pay. But what happens if it's earlier than that? We can't sit on cash and stay eligible, right? Because it has to be invested. If we redistribute that, are we triggering ordinary income gains for the LPs? It's something that we're trying to stay conscious of, and quite frankly, there's a lot of vagueness right now around ozone. So we're trying to give you what we know, and then I'm actually appreciative of you guys being here because there's some mind share with sophisticated people. A lot of times we're talking to the end limited partners. They don't have the expertise that sits in this room around taxes and investments.
this
So
has been a really good conversation, really
So
good
you're saying
questions.
in the absence of guidance, you're going to stick with it.
That's our plan right now. I mean, and it works out okay because the type of things we're investing in, hotels and apartments, things like that. I mean, we have expertise in owning and operating those types of businesses, so that kind of works for our business model. It may not work for a lot of different real estate business models, but we're until we receive further guidance on how that would work. But the plan for us is to stick with it and just hold it for at least 10 years. And then we would probably start liquidating in order to, cash out investors.
well, and I think as guidance comes out, you'll see potentially our asset mix change, right? If we know we're 10-year commitments, we'll do construction development because that's a much longer tail than if, hey, we're going to have to do this and turn cash quickly. We might go rehab a multifamily that we know would take 24 months and would be cash flowing on the next, following year. Was there a question?
No, I just think that speaks to your earlier comment about all the
Right.
coming out of the financial crisis, having got involved in different types of investing. This is just a tax vehicle.
Correct.
That's
Yep.
We built a platform that just happens to align with this. And I'll give you I'm full of anecdotal stories this morning, but this was last year in July. My team is small. We have about a direct team of 6 people that have raised the $225 million in equity over the last few years. We had just opened 2 new funds, and Chris came to our sales team in the sales meeting the week before and said, all right, guys, no more new funds, no more new projects. Let's work on what we have. The very next day, in the very next sales meeting, he walked in and said, I know I said no more new funds, but we're opening a new fund. And it was this. But once we all went home and did our homework, we quickly became excited understanding the opportunity and why he did that. And again, it was a collective effort. It wasn't just Chris. There was a lot of people on the team that were pushing this, and now here we are. And I quite frankly think we'll raise more money in this quicker than we've done in any vehicle, product, or limited partnership we've operated.
Yeah, go ahead. That's great.
The application of the fund itself. So a lot of times limited partnerships, especially in real estate, they're looking and getting the passive losses that in the early stages of the venture generate. How is that all?
How's that going to work?
Pass through work?
So to get pretty technical, and I think a lot of it we'll see, but to get kind of technical, because the investors they're reinvesting capital gains that they have not paid tax on, they have no basis. And so my understanding is that, as losses are passed through to those investors with no basis, basically they're going to be suspended. Yeah, I mean, it could be that the investors might have some debt basis, maybe something like that, where they could potentially. It could be that you have to wait until you have income. It probably just depends, but yeah, that by no means, this isn't a play to, this is a play for tax deferral. It's not a play to have passive losses that you're, you have to, it's tailored to a specific investor type, and it's going to be very different from traditional real estate partnership investments that we're all used to and we've all seen. how are we doing on time? Are we?
That's a good
Are
question.
we?
Sherry, what time are we scheduled?
We still have 20 minutes. Okay. All right. So no, all right. So let's walk through one example just to kind of put some numbers to it. Question before we do that.
Random question. How does it, you are investing or
That is a good question. I mean, the investment in, all I know is that the investment has to be in either a stock or partnership interest. So stock of a corporation, partnership interest of a partnership, or it has to be a directly owned, tangible asset.
I get that, but if you buy a property,
We don't have any guidance on that. What I would suggest, set up a limited partnership that's a business for cleaning up contamination and invest in that. You're good.
Yeah.
Right?
Yeah. I mean, I haven't heard anything relative to that, specific to that.
I haven't heard anything
I think,
on contamination.
yeah, I think, yeah, that makes sense.
A business that cleans up contamination.
Yeah.
Right?
Yeah, especially if they're, the offices, the property's there, the business is located in that opportunity zone, I think you're
It's
okay.
your office space.
Yeah, you locate on the
Co-headquartered.
locate on the contaminated property. I don't know. All right, so let's walk through an example here just to kind of put some numbers to maybe drive these points home, and then we can. I think we're pretty much through with the presentation. We can go to any final questions. So here, for simplicity, $1 million gain that you have. Gain happened from the sale of an asset on January 1st, 2018. You then reinvest that within 180 days into a qualified opportunity fund, full gain on June 1st. And then you hold that for 10 plus years. You exit on December 31st, 2028. So you held it for 10 years. So you're kind of investing at the right time. You're holding it for the right time. So you should be eligible for all the tax benefits. All right. So what does that mean? There's no tax on the $1 million capital gain that was reinvested. So there's no tax this year, and there's no tax until you're paying taxes for 2026. And it's not due till December 31st, 2026. So that's again, all right, first benefit. Put numbers to it. All right, because you held it for 5 years, you get a 10% step up in basis. You held it for 7 years. Before 2026, you get another 5%. So you get 15% step up in basis. So when you pay the tax, you're going to pay tax on a $850,000 gain instead of on $1 million gain. So, all right, that's a little nice bonus there. And then we have, all right, an additional $1 million gain just from the appreciation over that time period. That basically your investment's doubled in value. That full gain is going to be excluded from tax. So there's the, all right, that's, we're talking about a really good deal here. And then, so basically, in sum total, we've had $2 million of gains. We've only had to pay tax on $850,000 of those $2 million. And all right, so what does that look like? Simple numbers here, assuming 20% rate, and we know that that's pretty simplistic, but just for ease of the example, 20% capital gains rate. So 20% of that 850 is going to be due then on December 31st, 2026. We have an additional, instead of $200,000 that was due, the beginning of this year. So that's, pretty significant. That's almost, we're looking at 9 years if you got in right at the beginning of deferral. And then kind of on a, to put this in, present value, in time value money, put that into perspective. All right, so 20% capital gain using a 5% discount rate. Basically, the economic cost, $104,600 would be the actual cost of that tax. If you're adjusting for time value money, so you're reducing the cost of the tax just because of the deferral and what you could do with that money for that 8 or 9 period. The investment in the opportunity fund. So we're looking at $295,400 total kind of present value tax savings or cash savings rather, just for investing in this. I think it's just a 5% discount rate. So that's a pretty conservative. I think our, we have a target IRR for our specific fund that's like 13%, and I think, so that's just a conservative example. So you expand that to a 10% or higher rates, and the numbers are just going to be bigger and even more, make more sense to do this type of investment.
And on our own fund, that was a conservative intention as well with the IRR projection, simply because the margin profile and return profile of construction and development projects is much higher than that. But again, we're not trying to solicit investors for this fund for performance, right? It's a tax deferral vehicle, and we're going to try to marry that to the strategy.
Mm-hmm. So I think this is our last really opportunity zone slide. We have some more slides about our fund specifically that we may or may not get into, but
We'll leave that.
yeah, but let me just get through this slide, then we'll take questions, I think, and I think that might be best.
Yeah,
so the funds, what does it take for our partnership or any partnership, or it can be a corporation, to qualify as an opportunity fund? Basically, it's a self-certification on Form 8996. You basically, all that is required on that form is to check a box saying that your fund documents, the partnership agreement, or the charter of the corporation, what have you, basically state that it's a fund set up to invest in qualified opportunity zones, and then basically you're just showing that you meet the 90% test for the first year, which you would basically say, all right, 90% of the assets are invested in qualified opportunity zone property, and X amount out of the total is qualified, and then if you meet that test and then on a yearly basis, it's the average between June 30th and December 31st. So if you average is 90%, you're good. If not, then you have to look at it on a month-by-month basis. So you maybe meet the 90% test on 4 months out of 6 months, then you have a penalty due on those 2 months, and that's all that form does. Is it basically shows that you're meeting the 90% test. If you don't, it provides a way to calculate what the penalty would be for the fund. There's no limitation on the amount of capital gain. You can invest as much as you want into these opportunities on business. Like Travis said, you can diversify into multiple funds across different, whether it's real estate or actual operating businesses. You could do what you want, set up your own, et cetera. There's a lot of flexibility, and then there's no limitation on the amount of appreciation that will be basically shielded from tax. And really, it's a great incentive for investors to invest in these areas. And obviously, it's complicated. There's a lot of pitfalls. We're going to see people who are setting up their own funds. They're going to kind of struggle. So, it does require expertise and knowledge, and people are likely going to, on the flip side, if you're a CPA advising a business that wants to do this, you have to really understand the rules and regulations and make sure that they're doing the right things, especially leading up to these testing dates. So it's complicated, but it's also very exciting.
We want to open it up.
Yeah, let's open up to questions for the last few minutes.
So in your booklets, and again, this isn't a sales thing, but if you are interested in learning more about any of the caliber strategy, you just want to fill this out for us. So we'll be able to engage with you. If not, that's okay. Put that out there. It's in your booklet.
There's a question.
I think as long as the non-resident, so it would have to be a U.S. Capital gain, I guess. But I don't think there's any limitation on the residency of the taxpayer as long as they had capital gains. And it doesn't have to be an individual. It could also be a tax-paying corporation. We talked about partnerships a little bit. Basically, with regard to that, let me emphasize one thing: the partnership can elect to reinvest a gain in the in an opportunity zone fund. If the partnership does not do that, then the individual partners can, which it's probably not as likely that a partnership would unless it's a specific family type partnership. But the individual taxpayers then would have, the individual partners would then have the option to reinvest into the fund on their own. So if you have 5 out of 10 partners that want to do it, then they just have to do it on their own, make the election on their tax return. The election, just to emphasize one, I guess, tax technical thing, the election is done on Form 8949. I think that's the form that we're used to seeing where capital gain detail is reported, and I think it's just going to be a code on that form that you're electing the deferral on the gain this year. So we need to make sure that returns are timely filed and that election is done this year. That's going to be crucial and key, and that's going to fall on all the CPAs in this room that are have clients invested in this to make sure that that's done correctly, because I can imagine that there's going to be a lot of angry people if we mess up the election right in the beginning. So just another key thing to emphasize. More questions?
So, I mean, even though the market's soft, it's still the seller's market. So what we see a lot of is it's very difficult to execute a 1031 because you won't find quality property in time. And so the other two common routes that come up are trying to find a TIC or a DST, which are both pretty rare,
Mm-hmm.
right? And then, so these are popping up all over the place. It seems like a natural third option for that route. So I was wondering if you could talk about what are some of the pros and cons of this versus a TIC or a DST?
Yeah. So the question is, how does Opportunity Zone compare to a TIC or DST? I mean, I don't, I'm a little familiar with tenancy and common agreements. I'm not as familiar with the, I think, Delaware statutory trust. I don't know as much. I know that the main thing is there's not as many hoops you have to jump through. I know with a tenancy and common arrangement, basically all decisions have to be unanimous. You have to set up a lot of legal work and stuff. And really, as I mentioned, it's very easy for a fund to self-certify, and so there's not a lot of hoops you have to jump through. I mean, similar to the 1031 exchanges, you don't need a qualified intermediary or things like that. So, I mean, it's just a lot more flexible than those. Those are a lot more rigid and meet the requirements for maybe a specific investor set, but this is more broad and flexible.
And my limited understanding of both, and again, you might be able to correct me, but you're still getting taxed in those vehicles regardless of how you're being taxed. But at some point, that gain is being taxed versus here, you're deferring and the gain's not taxed at all, right? So I would say that, to me, just at the outset, would be the biggest difference.
What was the treatment of depreciation recapture? You mentioned earlier that depreciation recapture is not eligible.
Yeah, correct. So the question is depreciation recapture. So basically, it comes down to, all right, how is it treated on the taxpayer's tax return? If it's treated as an ordinary gain, then, which, as we know, sometimes depreciation recapture is, it may not be depending on the situation, I guess. But if it's ordinary, then it's not going to qualify. If it's a capital gain, like 1250 depreciation recapture would still qualify. But ordinary, basically, if it's treated as ordinary income, then it's not going to qualify. That makes sense. So yeah, it depends on the type of depreciation recapture. That was a good clarification. Thank you.
If the accredited investor requirement, is that a Caliber decision or is that?
That's a great question. To be honest with you, I just don't even know. We don't do anything with everybody's accredited that we work with, so I haven't even researched if there's non-accredited vehicles. I would think it has to be.
Yeah, it's not in the
I don't know
regulations.
many non-accreds that are really able to have capital gains of several $100,000 to invest in most of these funds minimum. So I think it's a natural that I want to say yes, but I'm not certain.
Yeah, there's nothing in the code or regs that require that. It's basically, I mean,
What about an heir? That would be the situation I could see. A wealthy
the heir
trust
doesn't qualify as an accredited investor, but they
but the
inherit
child doesn't. Yeah, how does that work?
Yeah, so I don't know how that works from I mean, that's going more away from tax law into like SEC regulations and stuff, but that's probably just because all of our investors need to be accredited, and that's why. But you could, in theory, have somebody who's not. If you could set it up, on your own, or find somebody else you want to partner with.
It seems like you would have to have a very aggressive acquisition strategy in place, and obviously you've been doing metrics on those markets for a long time and looking at those and building relationships for off-market type things as well too. I mean, is that going to be a need for the new people that come in? I would think that's going to be the biggest barrier to entry to try and build that infrastructure that you got. Is that correct?
I think so. From what I've seen and other groups I've spoken to, that's really what I've seen is you can raise $25 million probably if you have a decent network and you have a vehicle for it. Can you put $25 million to work with subcontractors, roofers, plumbers, all within those timelines? That's, again, back to our platform. We're comfortable that we can think it done, but to add to that, I mentioned earlier we did a calculation that about half of what we own in the state of Arizona fell into these designated zones. Well, we had a $100 million pipeline of projects across our funds before we even got started with those zones. So now, I don't know what the estimate is done on that pipeline, but I can assure you it's some of it will be qualified. And that's also why we're going to be a little more careful with this fund rather than, hey, I've got $5 million, here you go. Okay, we're going to take the ones that need to go now, and the ones that have some time, we're going to put in a queue and roll in as we're starting to, and try to match that pipe with the dollars we're taking in.
Yeah, and it really was, a very favorable coincidence for us with some of the deals that we're looking at for the fund. The first deals were already things that we're working on before this even came about, or earlier this year, or in the past. So there were things that were kind of already in place, and it just happened to work out that all right, we can do this via this fund instead of a different fund that we were looking at before. So it's great for us.
Well, we think that there's going to be a lot of ancillary benefits, not just to the ozone fund, but and not just our funds, other investors in the areas. But as I showed you, the 4 or 5 funds that we operate, we're in Mesa in the retail corridor right on Main Street. Those are likely going to be Opportunity Zone investments in the Opportunity Zone fund. However, there's thousands of homes in Mesa right around Main Street. Our residential fund will come in and start buying up homes. Okay, they need a new hotel across the street, and it's not in a designated ozone. Our commercial fund comes in and puts that over there. And so by lifting the resources with Opportunity Zone investments, we think there's kind of a rising tide situation, or could be, and that's really what we're hoping for.
I think that's the idea behind the law, is that it will revitalize these communities and areas, and help people out.
Any other questions? If you wanted to see these slides, or if you guys have to go, feel free. But it's just talking more about specifics on Caliber. Again, we wanted to keep this educational. However, if you wanted to learn more about what we're doing and what projects we're lining up, please come see us, and we'll follow up with you.
Yeah, and
Thank you guys.